Superannuation is about to undergo some big changes in 2025, with Division 296 among them. If your superannuation balance is over $3 million, you may be about to take a massive tax hit and on unrealised as opposed to realised capital gains. In this video, I'm going to take you through each major change that will be coming into effect from 1 July 2025 and how it could potentially affect your retirement plans. And please be sure to stick around until the end when I'll talk through one thing you should be doing before the end of this financial year. Now, the ill-fated Division 296 is well and truly back on the agenda. This is the so-called $3 million cap, the superannuation cap, the $3 million tax. The media is having a field day about it at the moment, and there are headlines everywhere. This all comes after a resounding Labor victory in the federal election that has this planned tax that would bring Australia in line with just one or two OECD countries in terms of what it will do to the way it will tax investments. And the idea is to focus on understanding what it means and what you should do and what action you should be taking from now and even from 1 July 2025. So while this is being referred to as a $3 million cap, it isn't actually a cap. It's actually an amount of capital from which you'll be charged an additional tax rate over and above that you were already due to pay. This Division 296, as it's known, applies to balances in super of more than $3 million. So if it were to come into force from 1 July 2025, from the end of the financial year, the portion of your superannuation balance that is above $3 million would attract an additional tax rate of 15%. And the kicker here, and this is what I'm incredibly concerned about, what the industry is concerned about, is that you'll be taxed that additional amount whether you have realised a gain or not. That is, if you own a property and haven't sold the property, but the property is worth more, you'll be taxed on the increase in the value of that property. And similarly, if you own a share and the share has gone up by 10%, you'll be taxed on that 10% increase, even if you haven't sold that share. That is opening a whole new can of worms for the Australian taxation system. So the key here is, how does it work in superannuation? So let's have a look at an actual example. If you have a $3 million superannuation balance, and of course this is $3 million in an individual, the $3 million cap applies to individual accounts. So if your super fund balance is $3 million in total, you won't be impacted by this change. But let's say you have a $3.5 million superannuation balance and you've got the maximum of $1.9 million in pension phase. The remaining $1.6 million, it will be in what's called accumulation phase, which means you are paying tax on the realised gains and income you receive at a rate of 15% on that $1.6 million. Now, under the change, you would continue to pay 15% tax on that $1.6 million, but you would also be charged an extra 15% on top of that on the earnings associated with the additional $500,000 that lies above the $3 million cap. That is, your return for the fund, all the income and unrealised gains that have been generated through the year will be tallied up, and the proportion of your fund that is above $3 million, in this case $500,000, will be applied as a percentage, and you'll be levied an extra tax that you'll get a statement for on that additional income, regardless of whether it's being realised or not. And this is the key here. Why is this so bad? Why is the media talking about it so much? Because it is proposing to tax unrealised capital gains. It's like if you have an investment property in your own name or outside of superannuation, and that property went from $800,000 to $1 million in one financial year because there was a popular suburb or a popular street. In this case, you would have to pay tax on that $200,000 at your marginal tax rate if this same law was applied outside of superannuation, as it is being to balances over $3 million. And secondly, the other issue is that it is not indexed. That means the $3 million cap will not be increased as the other contribution and related caps are, which means it'll impact a growing number of people over time. Now, the Treasurer came out and said that it's likely to impact 80,000 people, or just 0.5% of the population, whereas the Financial Services Council, lobbying or industry body, estimates that over 500,000 people that are working today will be impacted by this over their lifetime. One, because of the impact of compounding, and two, because of the impact of inflation. So what should you do is the big question, and the natural reaction is we need to take money out of super. I've already been getting phone calls about this topic, but the risk of taking out super is that you are then exposing it to your marginal tax rate or other tax rates. Work needs to be done to ascertain whether you're going to be in a better tax position or not by taking that money out of superannuation. And importantly, this hasn't been legislated yet. So there is no need to take action before this is legislated. And similarly, you do have a 12-month period through which your earnings will be assessed before you'll be hit with that $3 million tax. Now, when we talk about the tax rate between your superannuation fund and your personal name, if you already have income over $18,200 in your own name, you'll be paying a tax rate of 16%, which is above the accumulation tax rate. Similarly, if you already have investments generating income over $45,000 in your own name, then you may actually be worse off by taking this money out of superannuation. So the key is you will have time to sort it out. Now, there's a few other things that are going to be changing from 1 July 2025, which are worth looking at as well. The first is the super guarantee. The percentage of money that you are forced to put into super every year out of your pay, ultimately delaying consumption. This is set to increase again from 11.5% to 12% as of 1 July. Now, this is continued, and this is where it will stop for a short period of time, and it may be part of the legislative agenda again. Your first paycheck next financial year will show this, and if you're at a business, make sure you're updating your systems to pay the minimum superannuation at least to your staff members. The other thing we need to consider is the unused concessional contribution caps, and we've received feedback on this in previous videos. These are your tax-deductible contributions, and concessional contributions are limited at $30,000 per person per year. And what we're talking about here is the unused concessional contribution cap, which means you're able to use up to the last 5 years of these and claim tax deductions in the same financial year. That is, if you're selling a property, you have a large capital gain, or you've got a big taxable income, you can actually get quite a large refund or reduce your tax payable by using this strategy. Now, this only applies for those with under $500,000 at the end of the prior financial year, and you can only use the last 5 years worth of your unused cap. So from 1 July 2025, you will lose the 2019-2020 financial year and as much as $30,000 in concessional contribution cap if you haven't used it before. Now, the last two are interrelated. That is the total super balance cap. This is the amount you can have in superannuation before you're stopped from making co-contributions, further non-concessional contributions, and even using the bring forward rule. This cap is set to increase from $1.9 million to $2 million from 1 July and opens a great opportunity for people to review and reconsider their situation before the end of financial year. The last one is a transfer balance cap, and this is related to the total super balance cap. Your transfer balance cap relates to the most important thing about superannuation, and that is once you turn your superannuation into a pension, it becomes entirely tax-free up to this transfer balance cap. Now, in the case of the transfer balance cap, it's increasing from $1.9 million to $2 million in the same way as the total super balance cap is. That means if you think you might get a 10% return on $100,000, you could be saving $1,500 in any given year by waiting to commence a pension. So the key here is that if you're thinking about commencing a pension, thinking about retiring this year, you may be better off waiting until 1 July when this cap increases and you can get more into that tax-exempt pension phase. Now, I said at the beginning of this video, I'd give you one thing to go and do before the end of financial year, and that is go log into your MyGov account, link your Australian Tax Office to that, and go check your superannuation balance caps and your concessional contribution and non-concessional contribution caps to make sure you're informed and you can take control of your retirement savings and your retirement future. Once again, thank you for listening, and please reach out with any comments or questions. And if you're looking for financial advice, please send us an email.